Be Wealthy and Smart, episode 358.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about last-minute tax tips for you to save some money. And this comes to us from an article in Investors Business Daily dated December 18th of 2017. And it was written as if you were a financial advisor advising your clients. And since that's not who my audience is, I'm going to have to adjust this a little bit. So I'm going to mention the tips that they mentioned, but I'm going to vary from the article. I can't read the article verbatim because it would sound like you're a tax professional. So I'm going to read you the tips and you'll get the same good suggestion, but just know that this article by Paul Katzeff, I'm actually adjusting quite a bit. So the first thing he suggests is that there are lots of things that taxpayers can do to cut their taxes in 2017. So that's great news. And that these things won't be invalidated by the 2017 federal tax reform. So also good news. So one thing I want to mention is they suggest harvesting tax losses. So they say if you can harvest tax losses from mutual funds, at the end of the year, you're facing a large distribution from a mutual fund in which you have an unrealized loss, consider liquidating the position before the record date that you would have to own the fund in order to collect that dividend. In doing so, you will not only avoid taxable income, but also generate a capital loss. This capital loss can be used to offset other capital gains from the same tax year. And he says the extent to which your loss exceeds your capital gains can be used to offset up to $3,000 in ordinary income. Any remainder can be carried forward indefinitely. Another idea is to beware of the wash sale rule. This goes hand in hand with tax loss harvesting, says Ben Barzadeh, wealth advisor at Pure Shale Financial Group in Crystal Lake, Illinois. You might be able to book a loss now, but still like the prospects of holding the security long term. The rule prevents investors from offsetting gains with losses if the securities sold at a loss are repurchased within 30 days. But if the stock you like was held by a mutual fund, you can avoid violating the wash sale rule by investing in another fund within 30 days that holds the same stock, but whose portfolio is otherwise substantially different from the original one. The next idea is to maximize retirement plan contributions. If you're self-employed, you've got to keep your deadlines for action straight, says Al Zednik, president and CEO of New York City-based Troust Solis Wealth Management. If you're self-employed, you must set up an individual 401k plan by the fiscal year end, generally December 31st. Another thing you can do is put compounding to work for you. Another reason to make retirement plan contributions by December 31st is to give your nest eggs as much time to grow as possible. Contribute as soon as possible to give your money as much time to grow and build up tax-deferred earnings. Another idea is to convert assets to a Roth IRA from a traditional IRA. The amount that you convert will be subject to income tax, but Tax Audits Duval points out that there nevertheless are several benefits to conversion. First, when you eventually withdraw money from the Roth, the withdrawal will be free from tax and penalty if you're at least 59 and a half years old and the account is at least 5 years old. Second, you won't be required to start taking withdrawals until you reach age 70 and a half. In contrast, you'd be required to start taking withdrawals from a traditional IRA by then. So, with a Roth, your money can continue to grow tax-free. Third, whoever inherits your Roth IRA will have to take additional withdrawals, but they won't have to pay federal income tax on the money if the account's been open for at least 5 years. Since you'll owe income tax on any conversion amount, you might prefer to convert just part of your traditional IRA balance each year rather than all at once. If you convert some of it before December 31st, you won't lose a year. Next, pay state income tax and local property tax. Even if the taxes are not due until sometime next year, Duval advises clients to pay them before December 31st so you can take the deductions on your 2017 return. And finally, contribute to charity. Even if a taxpayer doesn't know which charity they want to donate to, they should give to a donor-advised fund before year end. That way you qualify for the deduction even though the money has not gone to its final recipient. And charitably inclined people can consider donating highly appreciated securities they've owned more than 1 year instead of cash. Then you'll avoid paying capital gains tax that you would have owed if you had sold the securities to fund a cash donation, and you can deduct the full market value of the securities up to IRS limits. If you're not familiar with a donor-advised fund, I actually have one myself. They are a phenomenal charitable fund. You can set them up at brokerage firms such as Fidelity, where mine is, and what it does is it allows you to donate to your fund, take a charitable deduction, and then you have time to decide when you want to donate the money to the charity. So in other words, it's as if your fund is a charity, which it is because you're donating it. It's a permanent donation. It is a charitable donation. What it is basically a holding account that then you can designate a 501c3 IRS acknowledged charity and donate to whomever you want to. So for example, I could donate $10,000 into my donor-advised fund in 2017 and then take my time deciding who I'm going to give that money to. For example, I could give $2,000 of it to the Girl Scouts in 2018 and $2,000 of it to SightLife, another charity that I donate to, in 2019. And so on. And I can spread it out over the years if I want, or I can donate different amounts, but I get the full tax deduction of the $10,000 donation in this year of 2017. So that's how a donor-advised fund works. They're a very smart tax planning tool and charitable giving tool. And if you haven't set one up and you're interested, there are different brokerage firms that offer them. So some great last-minute tax-saving tips for you to think about. And these are last-minute moves that you can make just before the end of the year to maybe minimize your taxes. It's a good idea to just take a look and see how much tax you're going to owe, and then take a look at the new tax reform bill and see what bracket you fall into, and if you might be just barely over the limit into the next higher bracket, you're going to want to take advantage of these strategies to get you hopefully into that lower bracket and save you a few percent of tax. So just some things to think about and some strategies for you. If you haven't yet subscribed to Be Wealthy and Smart, please hit the subscribe button and you'll be updated as soon as I have new podcasts uploaded. And if you're looking to get to financial freedom faster, go to lindapjones.com and get my 11 quick financial tips to boost your wealth. There are 11 quick things anyone can do to get to financial freedom faster. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.
Again, please check with your tax professional. Make sure these are the right moves for you. Don't just take anything that you have heard today and act on that without knowing your full picture of your finances.